Out of 100 people, 4 will get the message.
Most destructive disease known to modern societies. There is nothing which will destroy a society so thoroughly and so fully as letting inflation run riot. Inflation doesn't arise because you got consumers who are spendthrift. They've always been spendthrift. It doesn't arise because you've got businessmen who are greedy. They've always been greedy. Inflation arises because we as citizens have been asking you as politicians to perform an impossible task. We've been asking you to spend somebody else's money on us, but not to spend our money on anybody else. Everybody talks against inflation, but what he means is that he wants the prices of the things he sells to go up and the prices of the things he buys to go down. The real tax on the American people is not what you label taxes. It's total spending. If Congress spends $50 billion more than it takes in, if government spends $50 billion, who do you suppose pays that $50 billion?
Of course.
The Arab sheiks aren't paying it. Santa Claus isn't paying it. The Tooth Fairy isn't paying it. You and I, as taxpayers, are paying it indirectly through hidden taxation. Inflation.
Talking market and asset class cycles with Chris Vermeulen, Chief Market Strategist at thetechnicaltraders.com. This is a very important concept to understand because without understanding which phase of the multi-cycle set of phases we're in, investors and or traders can't really determine how to position themselves for the medium term. Chris, welcome back.
Hey, thanks for having me, David. Always a pleasure.
Always a pleasure to host you. Let's jump right into the charts that you've prepared for the audience. This is we've talked about this issue before, you and me, this theme, but let's revisit that because right now is a very an opportune time to revisit this topic. It seems to me, or it seems to a lot of investors and traders out there, that we are in a renewed bull rally. And you have a chart that explains why that may not necessarily be the case. Tell us why.
Sure. Yeah. So my whole idea here is it's based around Stan Weinstein's 4-stage analysis. And the key for investors and traders, because these 4 stages I'm going to show you here really apply on any time frame. It can be a tick chart, a 1-tick chart. It could be the monthly or quarterly chart. So understanding what stage an asset is in, whether it's a stock or an index, it doesn't matter. I'm referring to more or less the stock market as a whole right here. But there's 4 stages. Stage 1 is a basing stage, and I've got it red on here simply because a stage 1 is a very difficult time to trade. It's usually choppy markets, not a lot of opportunity, so you're best to steer clear. They're dangerous. Stage 2 is a bull market phase, and it's green because there's a strong trend. We make money when things are trending and have big moves. Then we've got a stage 3 topping phase, which is also red because it's a very difficult time. It's a lot like a stage 1, except for much more volatile. And sectors are all over the place. One week, one sector could be hot. The next week, it's not. And this is kind of the stage that I think we're in right now. And then we go into a stage 4, which is green as well, because there's lots of opportunity to the downside. Falling prices are in one way better than a bull market because stocks, commodity prices fall about 7 times faster than they rise. So I see this all the time. We can see a stock move up for 5 or 7 days, and one day the gains are wiped out. And that's the same with the stock market. We can see years evaporate in 1 year to the downside. So as you were saying, people are thinking we're in this stage 3, or sorry, they think we're starting a new bull market phase. And if we were to actually look at what the emotions are of the market participants right now, I'm seeing headline after headline of people talking about growth stocks are on fire. The new bull market has started. Last year was the bear market. We're good to go. But the reality is, I think we're really in this complacency stage where people are thinking the next rally is about to start. And we're in this kind of topping phase. And this is when precious metals and miners take off. And we've seen this happen over and over again in past bull bear market cycles. And the bigger the move in precious metals and miners at this stage, the more likely we are to have a stage 4 decline where we go into a real full-fledged bear market where things sell off. So that's where I think we are right now. We're seeing gold and gold miners lead the way this year. And, that's kind of where we are. And to touch on the cycles that you were talking about, the real cycles here in this market are, last year we saw the energy sector perform the best. This year, it's precious metals. Well, these are the 2 type of sectors that do well at the late stages, just before the market rolls over and has a huge sell-off. So this is why a lot of people need to be aware. Everyone, I think, is getting very bullish on precious metals and miners. They think it's off into the races. The reality is this is, I think, just a blip, a false rally before much lower prices for gold, silver, and miners, which you and I have talked about many times before. I think there's going to be a big reset in 2023, going to create an amazing opportunity in the precious metals space. But based on the super cycle, it's not going to happen till late this year at most. And I think there's going to be lower prices, a great opportunity to especially accumulate physical metals, because we could go into a 5 or 10 year rally in precious metals after this final cleanse of a bear market. So that's kind of the high level view of those cycles there.
Chris, can you scroll up to the stages chart one more time?
Sure.
I just want to ask you how you know which phase we're in, because the complacency phase that you were talking about, this minor uptick, if you just look at that particular chart pattern that's used as an example for those cycles, that uptick can be applied to, let's say, stage 4. It can be applied to stage 1, maybe. How do you know it's stage 3?
So there's a lot that comes in, but the basic really high level that Stan Weinstein uses, that I've used for years, is simply this dotted line. Now this is just an infographic, but more or less it's the 150-day moving average. A lot of people use the 200, which I find is way too delayed. I mean, you're looking at a full year delay. The way he looks at it, and same with me, is if the 150-day moving average is sloping up and price is clearly holding above it, then you're more or less in a stage 2. When price is below the 150-day and the moving average is still moving up, or it's flatlining and price is chopping around it, when it's giving mixed signals, you're probably in a consolidation phase or a stage 3, which is where we are now. And then when price is definitively below it and the moving average is sloping down, you're in a stage 4. So that's a really high level, just quick observation of where we are in those potential cycles. And then you can look at those other cycles of which sectors are performing very well. And we've seen things rotate through those various sectors, and with precious metals and energy leading the way, and PE ratios being very high, and the growth stocks clearly leading the way to the downside, it definitely is showing that there's not a lot of support in this market. And it feels like it's just, I hate to say it, it's like a sucker's rally. It's just this false bounce, this false bottom. And when the bottom falls out, man, it could get really, really ugly across the board. So that's why, if there's any time that somebody should focus on risk and position management, it's this phase. People right now are going to get hurt the most if they step into the market, because literally a month or two from now, we could be breaking down, we could be in free fall mode. And the scenario that's set up, as you and I have talked about this a month or two ago, is very similar to the 2000-2001 market top. It's a major reset, and the stock market might not just correct for a year. It could trade lower or sideways for multiple years, like the 2000 correction. I mean, the SP 500 took 12 years to recover after that. It's not something that anyone who's 45 plus wants to endure, lose 12 years potential. So
I guess if you're in stage 3, you have to ask yourself, do I want to, let's assume that we're certainly in stage 3. You have to ask yourself, do I want to ride out that bull rally, that false flag that you were talking about? Or do I want to just stay on the sidelines and be completely defensive, or all cash, as one might be, and ride out this giant roller coaster of a dip that's about to hit us?
Yeah. And I mean, I don't believe in holding assets that are falling in value. I mean, it goes against every bone in my body. It goes against every investor's goal is to make money. So the buy and hold is out the window. I think anybody who's more or less 45 plus, to do the buy and hold is extremely dangerous, especially with the setup that is unfolding. Because if you're 3, 5, 10 years away from retirement, or already in retirement, the last thing you want to do is go through one of these, watch your value decline, have to withdraw money to live off of when it's at a huge drawdown. So this is definitely, you need to decide, do you want to go through this and have a life-changing event, probably for the worst? It's going to be very stressful. In fact, there was a study done that says there was 6,500 suicides in 2008 to 2009, directly linked to the 2008 financial crisis of falling equity prices. So this could be another repeat, and it's way better to miss out on some upside gains if the market does start to move up. We can always get back in when we get a new buy signal, but it's not worth going through this. This literally takes people's lives. It is extremely dangerous. People don't realize what they're flirting with. We're on the edge, this market, to some very negative relationship breaking, all kinds of things in terms of family relationships. This type of financial stress does damage. So I'm all about how can I help and protect as many people as possible. You need to know it's not about making money right now in a stage 3. It's about preserving capital, protecting it in case the bottom falls out. And we can make a lot of money from falling prices. But the key here is, at least for the majority of people, to step back and say, you know what, I'm going to reduce my risk. I need to protect it. I think that should be everyone's focus here right now.
The S&P 500 lost 18%, nearly 20% over the course of 2022. Some would say that's already quite significant. Now, I don't know about families, being broken apart over a 20% loss in the overall stock market index, but 20% is not a small number for the largest index in American capital markets, Chris. My question is, how much further can we go before this is all over?
Yeah, I mean, I honestly think this, like the SP 500 from where we are right now, could fall another potential 37% roughly. I mean, that is
from
a
current
big
levels,
decline
from here,
from the current levels. So we'd be down like 40 and change. That is enough that creates a lot of damage, a lot of stress, lots of bankruptcies, you name it. I mean, that is going to be another standout event that resets the financial markets, like we saw from the 2000 market top and the 2008. So there's a lot of potential downside, and people just need to be aware that this is a very delicate situation. And the problem is most people turn a blind eye to the market when it goes down like this. 20% is literally just the topping phase, and then when it breaks down is when these big sell-offs go, margin calls take place. So, yeah.
I guess maybe this is human psychology, but typically when you talk about a major market move, either on the downside or the upside, in this case, the downside, people tend to associate that move with some sort of catalyst. Now, in 2008, it was the collapse of Lehman Brothers and the greater financial banking system, which caused a contagion effect all throughout American industry. Collapse of the housing market, mortgage subprime crisis. These are real catastrophes that we could all observe and feel. There was a palpable recession, unemployment skyrocketed, people lost their jobs, some people never recovered economically. This is all a very real and understandable catalyst. But now we're talking about another potentially worse decline in the capital markets, and I'm looking around and I don't see such a catalyst. Help me understand this.
Yeah, I mean, in most cases, we don't know what really is the big cause until it's really deep underway. I mean, at this point, stepping back, we could say, well, it has something to do with COVID, the COVID crash, and all the funding everyone got. They drove the prices overvalued. As I always tell subscribers, if something goes straight up and it goes too fast, too quickly, it's going to come straight back down and unwind in a really big way. We've got crazy interest rate swings. So who knows what the main reason is going to be? Typically, we know hindsight 2020 what it will be, but no one really knows ahead of time. It's just, it just could be a massive unwinding of leverage. Who knows? But there's always something that we can try to tie it to. But I mean, we don't really know the future, and that's the whole point of what I focus on, which is risk and position management. We don't know where things are going next. We just have to manage our risk and our positions as the market moves. That's the only thing we can really do. I'm not a huge into forecasting or trying to predict where things are going. I don't try to buy tops or sell tops and buy bottoms. I wait for a top to happen. I get out when it starts to roll over. Same with getting in. I wait for a big bottom. I wait for the new setup. I get in. It's not about playing the maximum extremes. It's about playing like kind of the safe middle section of these trends and taking advantage of them, because I'm a lot different than a lot of individual traders and investors. I don't like to trade a lot. I don't want to trade a lot of stocks. I want to trade ETFs, which is my core focus, on major indexes or commodities or bonds or currencies. And you can put a large sum of money in and they move slow and consistently. I don't want to spread my money out over a whole bunch of different positions. So I'm all about trying to do the best returns with the least amount of trading, which is the opposite of what traders want. They want a ton of trades and they want action, but I just want to grow all my capital in a nice steady way versus, trading a lot of stocks is more of a job. You got to really focus. It's not what I want to do.
I want to ask your philosophy on profit taking now. This is one of the biggest questions amongst traders, is when to take profits. It's one thing to have a position and write it out. Perhaps you got lucky, but at what point do you exit? Personal anecdotes, many people that I know personally have had great returns on a position, paper gains, and then someone asked them, hey, are you selling? No, I think it'll go up even more. And maybe it does for a day or two, and then it just crashes down to zero. Well, not zero, but all his games get wiped out in basically a day. It could happen. It has happened. How do you prevent that from happening?
Sure. So I like to look at the stock market as the ocean. And so here, if we take a look at my charts, the top chart here is my investing strategy. This is the weekly chart. And I like to look at it as the ocean because as we know, there's a tide that goes up and down. And so this long-term investing chart, which we've got the COVID crash on the left, you can understand or see when the market is in a bull market phase. When it's going up, we've got green bars and it's above the key moving averages, and we're in a bullish phase. The tide is going up. Naturally, you want to be long stocks. When things roll over and you get a sell signal, which happened back in last April, the market has been going down in sideways and the tide is going out. All boats go down, almost all boats go down when the tide is going out. And so we haven't been, and we don't want to really be long stocks. If we are, it's for a very short period of time. So understanding these big phases, in a bullish phase, you want to be in a bearish phase, you want to be out. When we break it down to a shorter term time frame, to answer your question of when do we get in and out, as an investor, you can use these type of investing signals. But if we drop down to a shorter term trader, this is my CGS strategy, which is the consistent growth strategy, trading the SP 500. We can get long when we've got buy signals. You get these beautiful long trends. When things are showing uncertainty, it goes to cash, it goes red, and then you get long. You get these nice long consistent trades. And it uses a lot of different things. It uses volume flow, what different asset classes are doing, cycles, just technical analysis in general as well. And so that's what I use to get in and out. And we see these red sections because the technicals are saying the market's not favorable. It could sell off and continue to go lower. So we much rather step aside, let it shake the market up. And then when we get a new buy signal, we move back in. And so that's what I use. And you'll notice here, once you're in a bearish phase, the stock market on average is actually going down more than it's going up. A perfect example of this is if we take a look at the NASDAQ. This in the past year, we've seen most of the time is red. It's in a downtrend, and we have these very short-lived rallies. And so these are kind of like the waves I try to focus on. I like to look at it like the ocean. If you're a surfer, which I am, you're waiting for those sets of waves to come in every 4 or 5 minutes. And so these are those ocean wave sets that we're trying to trade. You can get long, you know when to take partial profits, where to move your stop. And then once the wave passes or goes by here, you can play inverse ETFs to the downside. You can rinse and repeat. So these are the type of moves we're focusing on. And it goes back into different time frames. You can play these waves and manage your positions. It's the same with the SP 500. You can play all these waves in the SP 500 as well. So that's how I kind of manage these positions, is look at the waves. And I try not to get too into the noise and chatter, like the daily back and forth, because that's where people get sucked into the volatility and things like that. So it really comes down to being able to have profit targets and have rules. And your rules are what's going to help you avoid holding on to positions. As you said, you have all these paper gains and then everything crashes and you're still holding on to them. And now you're underwater, and you have to sell a position to lock in gains. And that's what I do. We focus on reducing our risk, which means scaling out of positions and then waiting for a new. Do you
have a target profit gain before you execute a sell signal or order? Like, let's say you're disciplining yourself. If it goes up to 10%, I'm selling. Doesn't matter if it goes up another 90%. Do you have such a number in mind?
Yeah, so depending on the strategy, like for the indexes, we're generally looking for like a 5% gain, a 12% gain, and then it goes up to about a 20% move, and then the rest will just run the balance of the position. So we scale out as it goes. For individual sectors, they move faster. We're looking for like 7%, 15%, 20%. They're usually a very quick move. So we scale out and we let the runner go in case it keeps going. And then the market usually will eventually reset, pull back. We can reload with all of our capital and then rinse and repeat. So that's every asset has got different characteristics. And so it requires a bit different of trading rules.
I think it's very interesting how people answer this question, because I've asked this question to other traders and investors before, and some people have told me that, well, this one particular person has told me that he doesn't actually have target gains in mind or percentages in mind. And the reason is that, let's say he has a target of 5% before he sells, and the asset goes up 4 and 3%, or 3 or 4%, and then he doesn't sell. You know, he's losing out on gains, and then it just goes down, and he lost, and he didn't capture those gains because it didn't hit his arbitrary target. How would you respond to that?
Yeah, well, you need to know the asset and the regular volatility. So as volatility change, our targets adjust.
Right.
So if we're trading in a really high volatile market, we'll extend our targets a little further because the stock market can rally 7 or 8% very quickly. If we're in a narrow range in a tough market like this, we actually will scale back our first target to about 3.5% on like the SP 500, because we want to hit a target quickly and reduce some exposure in case it just rolls over and falls. So you know, there is no solid numbers you stick with. You have to breathe with the market. It's a living kind of organism. As it gets volatile, you have to open up a little bit. As it gets really dormant, you need to tighten things up so that you can hit those targets. And the nice thing is, once you hit a target, our stop comes up to break even right away. So if it does just roll over and keep selling off, at least we locked in a portion of profits and the rest gets out at a break even. So you really, I mean, it all comes down to managing positions. And you have to have rules to get out and adjust them with the market as it, you know, changes, because the markets go through different phases, volatility and trends and things like that.
You're a surfer, Chris, so you know that the larger or the stronger the winds, the larger the waves. So yeah, let's extend this metaphor to trading now. Are you feeling the winds of volatility blowing upon us right now? Are we about to see big waves, or right now are we still in the complacency stage where the waves are relatively calm?
Yeah, I would say right now we're in, if you've ever been near like an inlet on the ocean, or where there's a harbor with a break wall and it's kind of in a protected area, when the waves hit the break wall, they bounce back, but then they hit the other waves coming in. And instead of seeing like nice, clean little waves, the water's popping all over the place, random. It's just chop, right? And so that's the complacency stage. That's where I think we are right now. Things are popping and dropping. The market's kind of all over the place. It's a very difficult time to trade. And it's kind of like, maybe change it to the weather more so. It's almost kind of like the wind's fading. It doesn't know what it's doing. It's the calm before the storm, or the wind can swirl around like 180 degrees. You see the front coming. That's what I feel. We're in this really kind of just choppy, the calm before the storm. And the question is, are we going to get a bit higher pricing and rallies going forward for another month or so? Or is the front going to hit and we're going to see the winds blow and it's going to just blow everything over and sell off? So that's where I think we are.
Tell us how you're positioned right now then.
Yeah, we're positioned in cash right now. Our long-term investment, we've been out since April. And as our other trades, we are sitting literally 100% in cash, and just literally just collecting interest from either you can be in bill, which is a short-term treasury note ETF, and just collect a little bit of interest. So you're still making a bit of money, or you can just stick with your broker, which a lot of them are paying about 4% interest with a cash. So cash is a perfectly safe spot. It's where we are. And we're very close. We could actually have a buy signal in this market in a day or two. We're very close to seeing another little leg up, not a huge leg, but I mean a 5-10% rally in the stock market, which would just continue to kind of be the market moving higher in this kind of consolidation phase, this complacency move. So we're really just kind of waiting for the next signal. But I think when you look forward, probably 5 months from now, we're probably headed a lot lower. And you need to be prepared for it in case it happens. Have a game plan to get out.
Okay. Now, what is your game plan to get out? At what point do you say to yourself, this drop is enough, time to rotate back into risk?
Right. So to get back into risk, we'll be looking for our investment, our weekly chart strategy for that to kick back into an uptrend, saying, longer term trends, money flow has been consistent for a certain amount of weeks. Certain sectors are moving up. Precious metals will probably potentially be kind of keeping up with the market, but not outperforming. I don't think precious metals are going to have a huge rally unless we get this big market crash. I think they're going to continue to kind of keep up. So more or less, I'm waiting for our investment strategy to get long. Once it gets long, then our CGS strategy will be much more aggressive and be able to get in and play these moves. So we're just waiting for a new set of waves, but we need the tide to be going up first. So that's the biggest thing, is just waiting for the bull market phase to kick in. And then we wait for the CGS strategy to say, hey, here's a set of waves, or here's a new wave, the first wave coming, let's get in on it. So right until that happens, we just kind of sit in cash and wait. And it feels good because these markets have been so volatile. It is nice to see things just chop around without us on board, doing the emotional roller coaster that it can give you.
Okay. Finally, Chris, we have a few minutes left. I want to talk a little bit about your background and how you became a trader, and some of the most important lessons you've learned over your career as a trader.
Sure. I mean, going all the way back, I was 16 years old. I had my finance class in high school, and we had a stock market challenge, and we had to compete against other schools. And we didn't win. We were far from it. But with a $100,000 account, we made I can't remember what it was. I think it was like $80,000 in change in a semester. And that was it. I was like, oh my gosh.
Right? $100,000 of virtual money, not real money.
Virtual money, totally, yeah. Of course, we were trading individual stocks, and anyways,
I'll let you finish your story, but just real quick, do you feel different trading virtual money versus real money? Like, what you feel your risk tolerance goes up or down? Psychology changes?
I'm pretty good for trying to keep real. I don't like cheaters. I don't like bending the rules. I'm a stickler when it comes to stuff. So I'm pretty good. I can treat it just like real money, or I can say like, I'm just going to have fun with this and I'm just going to go. So I can handle that. But most people naturally.
I wonder if the psychology of traders or investors is different for managing your own money versus managing a portfolio of your client's money. Have you read or encountered such a difference?
I think so, for sure. So I do the trades that I give to subscribers, and well, for two reasons. First off, I built the strategies for my own money and to fit my lifestyle of how often I want to trade.
Right.
And second of all, when we're in the trades, I know exactly what they're thinking and feeling because I feel the same thing. I can control and contain it. I've got all my systems in place and checklists and things to keep my brain in check. And because I'm helping kind of mentor others, it really focuses me on staying focused, right? Mm-hmm. So that's how it definitely affects other people. If you're managing your own money, it can get in your head. And that's the nice thing about strategies. It allows to take some of the, if you don't have a strategy, you're always second guessing yourself. You're worried, you're thinking like, what's next? What's going to happen next? But when you've got something in front of you to follow and you've got rules and you believe you understand how everything works, it takes a lot of that stress and emotion away, so we can just trade together. I know what they're feeling because I'm doing the same thing, right, and go through it that way. Oh,
final point, I'll let you finish your story. You're reading these finance textbooks and perhaps investing books, that one of the core principles of being a good investor is to understand yourself, understand your strengths, your weaknesses, your likes, dislikes, understanding what you know best. And when you're a money manager, of course, you know yourself, but when you're managing accounts for other people that may not be in the same age range as you or same profession as you with different needs, it's difficult, right? Because you don't necessarily understand your client to the same degree that you understand yourself. So you're building a portfolio with a different ethos that maybe you're used to.
For sure. So I'm trying to focus on investors like 45 and plus, because that fits in the category I'm in. People who are, I think the buy and hold strategy is very dangerous for anyone who's 45 or plus, simply because there's going to be huge potential swings, multi-year drawdowns. So I focus the strategy around what I need, but it also benefits anyone 45 plus. The other thing is when you talk about knowing your personality. So I wrote a couple very detailed articles, even with the quizzes and things, about the Myers-Briggs test. And I don't know if you know about that, but it tells you your personality. And so I did this big article. It's on my blog. and telling subscribers, like, here are the different personality types, do the test. And if you fall under these types of personalities, you're more inclined to require a strategy or a system, like somebody who provides you signals. Some of you might actually just need automated trading because your personality doesn't bode well for trading and investing. And then there's others where I'm considered like the scientist, very technical, very logical. I like the numbers. I can control things. I'm a checklist freak. So understanding your personality type is really, really important. And if you don't know your personality type, you should go figure it out, because it really plays a big role into figure out, should you be managing money? Should you have most of it, managed for you? Because the reality is, I think it's about 70% of the personality types, based on my analysis and the stats, you're not set. You're not good for investing and managing your own money without some help from either, a newsletter like what I do or an advisor. You need that helping hand. So personality is huge into if you're going to naturally be a good trader or you're going to struggle.
Mm-hmm. I'll let you finish your story. So you were 16, you were trading stocks in a virtual account in high school, and then what happened?
Right. So I got hooked on it, went to college, got my first account was with TD Ameritrade. I bought Palm Pilot. I made like $8,000 of change while I was in Florida on holidays. Didn't even look at the stock. I came home, I cashed out, spent all the money on live seminars, like weekend seminars in Toronto, learning trading and stuff, got fully hooked. And ever since then, I was like, you know what? I'm going to learn to trade. I'm going to manage my own money, and I'll just share my trades with others and run a newsletter. And I've been doing that since 2001. And I mean, that's it. I've just never looked back. This is my passion. This is what I love to do. I live and breathe it. And I'm trying to build and manage the best strategies possible. And I just share them with others because it's just, it's really fun, and it's really enjoyable and rewarding. I mean, we had a subscriber the other day say he avoided the bear market last year using our signals. He had enough money to buy the property behind him, which connects to his other 40 acres onto this river and this pond. And he's coveted that piece of property for 40 years, and he finally got it. And I mean, this is what it's all about, is protecting your capital during one of the toughest years in a long time for investors. And he actually was able to go and invest in another piece of property, versus if he had been holding, he would have been down huge and he wouldn't have been able to afford it. So these things are like what I really focus on, is just being able to live life. It's all about, if you can manage your risks, the profits take care of themselves once you get these big trends. And that's just been my passion, is the markets. I mean, one of the big things you mentioned, what kind of helped me become a good trader, is I became a pilot at 14 years old in Canada. There's like no limit. So I could fly a car across the country, or a plane across the country, before I could even drive a car legally. And if you know anything about pilots, it's all about checklists. You got it strapped to your leg. There's a pre-takeoff checklist. There's checklists for everything. And that's how I kind of built my trading strategies. And I built a trading course around it. If you build your checklist of your trading rules, you're going to realize where you're missing things. And trying to create a checklist builds you a strategy, and then you just follow it. And that's what I've done since I was 16 years old, is just apply everything I've learned, the checklist. If you don't do the checklist, you're going to die in a plane, more or less. So that's how I look at it as an investor. I'm like, if I don't follow this checklist, I could get hurt really bad. So I just, a lot of times I don't want to do what the strategy does. I'm like, I'm not feeling it. I'm really nervous. But one of my old partners said, the more nervous you are, the better the trade will be. And that's generally how it works out. It's the market as a way of making you not want to do something when you really should. Finally,
give us one example of a memorable bad trade that you've made, maybe in your early days, that taught you a very good, important lesson.
Well, I've blown up a couple trading accounts, mostly when I got into futures trading. And we all moved to futures for the leverage, and we want to make a ton of money really fast. And I blew up 3 accounts in total. 2 of them were with futures. And one of the more recent ones was I was into a bunch of penny mining stocks that have been worthless. You go from like 10 grand, they're worth like $800 or $500 now. One of them had rolled into a marijuana company. And I remember looking at, my RBC account where I just had it stashed away, and it was like worth like $50-something thousand. And I remember asking my wife, I'm like, what should we do? Should we sell these? She's like, oh, just keep them. And I did. And I kind of just turned my eye to them. And now it's back down to like $1,200. It's worthless. And that was only a couple of years ago. So we all make these mistakes. And the easier the money comes, the easier it is to lose it. And that's what happened there. It was like, oh, it was like a free 50 grand. And I just kind of turned a blind eye. I'm like, I'll just let it go. And that was my most recent, like, what a waste of money.
Yeah, back to the discussion of taking profits. There was a, why didn't you, we'll finish on this, you saw the 50 grand, the 50K gain. Why didn't you take the profit, Chris? You thought it was going to go higher?
It was simply because it came out of nowhere. I'm like, well, I'm just going to let it run. I mean, it was just kind of a really stupid move. And I listened to someone else, and I'm like, it fell in line with what my gut wanted to do. I'm like, well, just let it run. It might be worth 100, because it caught me out of nowhere, right? I hadn't looked at this account in years. So it was just like free money. It's almost like, you roll the dice, double or nothing, and that's what I did. And I paid for it. And I still think about it occasionally. I'm like, what a stupid move. But,
well, you didn't lose money on
right?
that, right?
Nobody's bulletproof.
Yeah, I think the psychology here is that if you don't, as long as it's still in the positive, maybe you care less because you're not losing money. You feel worse when you lose money. Actually, it's been shown actually that people feel worse, psychologically speaking. They feel worse when they miss out on gains as opposed to actually losing money, which I find very interesting.
Yeah, FOMO, it's so strong. It's actually, we surveyed our users, and it was the number one thing they wanted help with was controlling their FOMO, their fear of missing out. When they see the stock market pop and rally and they're not in it, or an asset that they like, man, it's like sticking a knife in them and twisting it. Like it hurts. It hurts a lot. And that's where, my newsletter, every morning I do a pre-market video, and we walk through what to expect, the type of volatility, expect a big pop, in the next day or two. Don't feel like you're missing out, because this market doesn't know what it's doing. This is just noise. So I really help try and gauge that with people's, having the mental game is huge. It's the biggest part of trading, is being able to control your thoughts, your emotions, and have the self-discipline to not get sucked into it. I built an indicator that tells us when there's FOMO and everybody's buying, and when there's FOMO of people literally selling, the panic selling. And we use it all the time on our charts. And I mean, it tells us when we've got people all running for the door, which we had not that long ago. In fact, if we were to look at the charts here, this is the SPY, we had panic selling. On our panic selling indicator, it's green, because when everybody's panicking, stock market's selling off, and then the market gets oversold, and then it takes off to the upside, and then you get this FOMO of people missing out. The masses are moving in, and this could very easily move right back down. So we gauge this, and because I can physically show members, I'm like, do you feel like you're missing out? Because everyone else is, but don't worry about it. This is just volatility. It's just noise. And so I'm trying to handhold everyone to not get sucked in and feel that extreme of, oh, I'm losing money, I'm missing out. And unfortunately, they always feel it when there's a big move. And a lot of people think if there's a big move, they should have caught it, but that's not the reality. If you actually manage risk and positions, you can't just catch every move without gambling and guessing when something's going to happen. So I'm kind of the really sober. My strategy is super slow. It's really boring. It's dull. It's like watching paint dry, some of the subscribers say, but they love it. And the reason is, if something's boring and feels slow, it's because you have a process in place. You know what to expect. There's no surprises. And so my daily kind of updates kind of keep them in the action. They trade around my analysis all the time. But it's all about having systems in place and understanding the 4 stages we talked about, and how price can move to manage positions.
All right. Well, Chris, I appreciate your insights. Thank you for educating us on your techniques and methodologies. I look forward to speaking with you again soon. And before I let you go, where can people follow your work?
Sure. Yeah. If they want to find my work or my free blog and videos, they can go to thetechnicaltraders.com. And fully loaded, lots of stuff in the blogs. Go check out the personality test. Probably just search, personality test technical traders in Google. It'll probably pop the article right up. But really important, know yourself. Will save you a ton of money.
All right. Well, thank you for being on Kiko. Thank you for your contributions to the channel, and best of luck with your trades.